computer. All right, here we go. Another episode of the Equity Accelerator Podcast. I have a roundtable discussion here with Kevin Kirkpatrick from Lake Oswego Wealth Strategies. We've got Aaron Moomaw from Cascade Sotheby's, and my friend Corey Kaster is joining us as well from Insurance Masters Northwest. And the idea for this episode is to discuss, I wanted to give a little bit of information up front on the state of the mortgage industry, which is definitely wounded at the moment. But I also wanted to give an update on, financial opportunities and money-saving tricks and ideas while we're all sheltering at home. I'm coming to you from my pandemic bunker in Southeast Portland, and we're all in our home office right now and just doing this conversation virtually as we normally do, but now we do it because we have to. But this is the first week of April, and this is our first, beginning of the month since we've been on a type of lockdown. We're all coming from the state of Oregon. We've been on lockdown. This is our third week, I think. I kind of lost track of time. The first week seemed like I couldn't tell if it was real or if it was just our family deciding to do it. But then, I don't know. I've been at home for 3 weeks. I can tell you that. We're seeing a lot of job loss. And the big story in the mortgage space is, well, I lost my job and I don't know when I'm going to get my job back. And I heard you can just make a phone call and take a break on your mortgage. And that's true. Every mortgage company has a forbearance policy and is designed for figuring out a way to give people payment relief if they are in some kind of hardship. Usually it's like a medical issue, but this is more like a natural disaster type of concept that we're dealing with here with COVID-19. And so the idea is that you can do that. You can call our parent company, Sierra Pacific Mortgage. I have a handful of clients that have called it in and have received a 90-day forbearance. But what happens is it's not forgiveness. That those 3 mortgage payments that are now due on July 1st are actually also due. You have 4 payments due on July 1st. So you've really just taken a small break. I think it makes sense to apply for that type of payment relief if you are trying to pull together cash and you just need a few weeks to get like unemployment benefits to come through and the SBA loans and these kinds of fiscal relief policies, maybe pull some money from family members, that kind of thing. Because that payment is coming due, there is a lot of information floating around suggesting that anybody can just take 3 to 6 to 12 months off of their mortgage payment and it just gets added to your mortgage balance. As of the time of this recording, there's really no guidance on the mortgage servicing side on how we're going to be able to manage that. Mortgage servicers have contractual obligations to collect that payment and advance the payment to the bond investors once that loan's closed. And so any forbearance that we give to our, mortgagees, the mortgage company is actually making the mortgage payment for them. So at this scale, this type of cash crunch will potentially put some of the bigger servicers out of business. They were not designed to just make people's mortgage payments on that scale. So we're hoping that the government will step in and create some kind of credit facility to help mortgage companies navigate this. But time's really running out. I think we have a few weeks and the government hopefully can support this specific issue. But if that doesn't happen, I think you're going to see some pretty big mortgage companies stop operating. And they'll just have to file for bankruptcy and just do their best to manage the fallout. And that's not good for anything. The second component that I think is influencing the mortgage space right now, it's related to forbearance. But it's more related to the pandemic's effect on employment. And because so many people have lost their jobs and there's not clear when those jobs are coming back, the appetite for mortgage-backed securities has gone to zero. And so the mortgage industry writes mortgage contracts and sells them into the secondary market. And that market has, collapsed is one way to describe it, but it's really, it's just hit pause. No one wants to buy mortgages because they're not sure what they're going to look like in the near future. 20% of these mortgages may go into forbearance and I'm not going to get paid as a mortgage bondholder. So the market for those has really gone into disarray. But the Fed, a couple weeks ago, when they said they're going to lower rates to zero, also said a couple other things that were actually much more relevant to the mortgage space, because Fed lowering rates to zero affects other areas of credit. It affects banking in different ways, but they also said they're going to step in and buy a bunch of mortgage-backed securities. So the Fed is the only buyer of mortgage-backed securities right now, and they're buying a lot of mortgage-backed securities. So they're keeping rates low, and they're keeping most of the mortgage space functioning. We're still writing loans and closing loans, but because of these weird new layers of complication, the pricing is a little funky at the moment. I'm hoping that'll settle down, but there's definitely, we're shrinking the types of loans we're writing. We only want, A+ credit, lots of cash reserves. You have to sign something saying I'm not going to apply for forbearance and my job is not impacted negatively by the pandemic. There's lots of, all the loans we're writing in the future are going to be the A++ loans. So I think that I'm going to hand it off to Aaron here to talk about how that might impact our real estate market moving forward. There's going to be fewer qualified buyers with the lack of jumbo financing and reduction of, an expanded kind of credit guidelines that we're seeing. So how is that looking for you on your side, Aaron?
Yeah, thanks, James. I'll introduce myself real quick. My name is Aaron Moomaw, and I'm a realtor with Cascade Sotheby's International Realty. I've been a broker since 2005. So I've seen some ups and some downs, and this is definitely a whole new world we're living in with the pandemic. And then to answer what you're talking about, James, with how the guidelines for loans are going to directly affect what's happening now with buyers in the market, that jumbo side of things. So the 750 and up price range, we're already seeing a bit of softening from that as the jumbo loans are becoming almost non-existent or very hard to come by. That higher end market is starting to soften, but ultimately still so far the inventory is really, really low. I'll throw out a few statistics that can help the audience get an idea.
So there's fewer transactions happening, but also fewer people who are thinking about selling are deciding to wait. So
correct.
Right.
Yeah. So the biggest, I think the most relevant statistic for what's happening right now, which is ultimately keeping prices firm where they're at, is that inventory has gone way, way down. So just if you look in February from year over year, inventory was up in February 12.9% for new listings. There were 17.7% new pending sales. Sales rose 0.5%. And then just this last week's statistics from the end of March show that we had, new listings were down 10%, pending sales were down 28%, and new solds were down 24%. So that is a direct correlation to this pandemic. Inventory is down, even though we have
that's a total reduction of transactions, right?
Total reduction. So if you looked at 20 new listings in your neighborhood, that means there's 15 new listings now. And so even though these guidelines are tightening up, I'm seeing with my clientele, colleagues are sharing with me that that 300 to even 600 price range in good neighborhoods, the listings are high quality. They're going quick. I mean,
They're
we're
being
still
absorbed. Yeah, there's still a lot of
yeah,
buyer energy that
yeah,
hasn't left the market yet. I think that will cool off a little bit as maybe people will just kind of, as buyers, kind of wait and see what changes. I mean, I think a lot of people are like, I'm waiting for my moment. I'm waiting for the crash,
right,
and then I'm going to buy.
right.
I don't know that because of what you're saying. I don't know if we're going to see a crash. I do think we will see a softening of real estate, but I do also think it'll be fairly temporary. So there is an opportunity if you're a buyer and you're waiting for prices to come down. I think your day is coming. I think your day is
Yeah,
coming, and maybe also you'll be able to buy something without the level of competition
yeah,
that we've seen recently. What do you think
yeah.
about that?
Opportunity wise, there will be more opportunity as we continue on. Longer we're in the shelter in place, and the longer that the guidelines stay what they are, I think we'll certainly see softening as unemployment continues to rise, and
Right.
then the availability for loans from the low end to the high end, those shrink up. It's ultimately going to cause a softening. The
Yeah.
real estate market, like you and I have talked about this, and over the course of this last week, the real estate market really doesn't start to feel the effect of an event like we're dealing with now for a few months
Right. Right.
after.
Because when
So,
you want to put your house on the market, you prepare for a few weeks, and then you get it on the market maybe a month after you decide to do it. And then, so what we're seeing now is the result of a bunch of real estate decisions that happened 60, 90 days ago before the pandemic. So we haven't even seen the full weight of the pandemic arrive in our market data. But
correct.
anecdotally, we're still seeing a lot of buyer activity. What would you say the biggest opportunity if we see a slowdown? What does that look like? How can you win in a market slowdown as a buyer or a seller?
Right. Well, it depends on what market you're in. If you're in that upper end market, so if you're a buyer that's maybe moving here from California, or you have cash to come into that upper end market, and your competition was anyone getting a jumbo loan,
Right.
you're coming in with cash, I see you have probably the potential to get a 10% discount, maybe even already or in the next month or two.
Yeah.
And then that opportunity will continue to grow. And you can speak more to this, but I don't know how soon those jumbo loans are going to be readily available again. I would imagine 6 to 12 months, maybe.
12 months, it's hard to imagine them being gone for 12 months. I mean, they still exist, but they don't
Right.
exist nearly to the extent that they did 2-3 weeks ago. I think you can still get a jumbo loan directly from bigger banks because those big banks don't have to sell their loans into the secondary market. They can just put them on their books and lend against their deposits. So the big
Yeah.
banks have an advantage there, but I think that those loans, those banks will probably demand a higher quality borrower, more cash reserves, better credit, tighter ratios. And because of the traffic jam that, if they're the only game in town, I think they're going to take a lot longer to close.
Yeah.
So I think if you are a buyer and that cash buyer is so much advantage to someone who is still a jumbo borrower, but maybe they need like 100-day close, like it's going to be crazy. So if you have cash, maybe the move is to like show up, write a big check, and then call the big bank and pull some of that money out, then take your 100 days to get the refi at that time, or wait a year for that market to return. It's a good market, but we need employment to stabilize. And and so once that happens, I think once the medical piece of this resolves and the people kind of get back to work and we realize that we're not at this insane 20% unemployment rate, the jumbo market will return. So I feel like if you're saying 6 to 12 months, my sense is that 6 is more likely than 12.
That's great.
Yeah.
Yeah. And, you know, and speaking more to the masses, because that's a much smaller percentage of the market, anyone that is in a position where they're confident that their job is going to be secure and they're looking to buy or sell a home, it's still feasible to do that right now. We're maintaining all of the CDC guidelines when we're putting a house on the market. So, you know, it's going to look a lot different than it did to sell your home today than it was a couple of months ago, even a month ago. We're not doing open houses. We're going to be solely doing virtual tours and trying to really only get buyers coming through a home that are pre-qualified, have seen the home via virtual tour, have done a drive-by, gotten to know the neighborhood a bit. So limiting showings, but it can certainly be done. And I just say, my opinion on it is if you're in a spot where you don't need to sell right now and it's just a want move, I would highly recommend considering, if you're living in that home, waiting until we get through to a time where that shelter in place is lifted. If you're selling a home that's vacant, it's a rental property, certainly we can get those houses on the market and do it in a responsible way. So
it seems like the best situation to be in real estate at the moment right now. This is like the fantasy. This is the fantasy scenario. You move out of your house and vacate it. So you have a vacant house to market. You find some other place to live in the, you know, in the meantime, maybe with family or with maybe like
camping somewhere,
Airbnb or something. This is a fantasy, like, but hear me out. You know, so you have a vacant house to sell. And maybe you're selling at like 550 and you can free up like $300,000 of equity and you want to leg up into 750. And now you just move that $300,000 into that upper 750, I would say is kind of like where you start to get into jumbo competition.
Right.
But the buyer I'm describing doesn't need a jumbo loan. Correct. So they can show up and buy that house. It would be potentially contingent, or if they're just selling a vacant house, then they're non-contingent. Potentially you free up the cash and you show up to buy that $750,000, $800,000 house with $300,000 down. I think that you could probably benefit pretty well from a strong market on the sale, and then benefit as a buyer from a softening section of the market up in that $750,000, $800,000 purchase range. That's just a fantasy I've dreamed of.
That's a good one. You know, and just so our audience, anybody listening, that 510 is the jumbo limit. Correct.
Yeah, that's national too. So 510. So if you're in Nebraska listening to us talk about these purchase prices, you know, this is the reality of West Coast real estate. And apparently Portland is still relatively inexpensive compared to most other comparable.
Compared to all the major cities on the West Coast, we're still the most affordable, you know, when you're looking at San Francisco, Seattle, LA, San Diego.
Well, speaking of job loss, I know a lot of people are wondering about, you know, how am I going to make ends meet if I can't find another job? I'm stuck at home and I'm just so stuck. My heart goes out to people that are really in that situation. So forbearance is a good option for someone in that situation if you're a homeowner. But you can also apply for forbearance on everything, not just the mortgage. I would say go on a forbearance rally and just like call every utility, call your car loan, call your student loans, and credit cards, everything, and just tell them that you get on a payment plan with them. And I think those institutions are, I think, much more well suited to come up with something that won't further sink the economy. But then once you kind of like cleared the decks as much as possible, then you start prioritizing your bills moving forward. And I would say prioritize your mortgage, prioritize your rent payments as best you can, and then push everything else off. And I brought Corey on here to talk about ways to to explore your insurance holdings, and ways to find savings in that, because everyone carries insurance, and this is an easy win for people who are looking for ways to trim out money.
Yeah, so a little bit of background about me. Again, Corey Kaster with Insurance Masters Northwest. We've been around, similar to Aaron, since 2005. So we've seen something somewhat similar to this before. This being a strange anomaly just because we were in such a strong market going into this, and then it just sort of paused everything. But what consumers can do is shop out their insurance. One thing I think that a lot of people don't realize is there's rate creep, which basically means when you get locked in with State Farm or Allstate or any company, then your rate is just going to slowly increase, and it can sort of be the frog in boiling water. Mm-hmm. And they're not going to change it unless you give them a call. So the first step is always to give your own insurance company a call and see what they can do. I know some companies you can delay payments. I know Washington State, for instance, just announced that they're not going to incur any late fees or cancel any insurance for a set period of time, those sorts of things. So there are ways, if you have no income at all, that you can at least pause things for a period of time, but also just call your insurance company and see if they can reduce your premiums at all. And then the next level is to chat with a broker. So if you're with like an Allstate, State Farm, Farmers, is to call a broker, because they're going to look at a bunch of different insurance companies and see who has the best option. And for instance, I mean, I've saved between 2 or 3 clients just this week, thousands of dollars combined on their insurance for the year just by shopping around to a different insurance company. So they're not losing any coverages. They're just getting with a company that's going to give them a better rate for the time being. And then you could also do things, if you have multiple cars that you're probably not using very much, consolidate to just using one car. And then if there aren't loans on those other cars, put them into storage, or comprehensive only as it's called, because that's just a few dollars a month. And then you're not paying these liability coverages for insurance policies you're not really taking advantage of.
What would you say about temporarily like stripping out some coverage? Are you advising around that in extreme cases?
Well, yeah, it sort of depends on what you're stripping. On your homeowner's insurance, there's not much that you're probably going to want to strip, because it's sort of cutting off your nose to spite your face, because heaven forbid something happens and that thing isn't covered.
Right. I mean, that's always the problem.
But on auto insurance, I mean, even if you say, for instance, you have 2 vehicles and you have loans on both of them, so you can't switch either of them to storage, you can cut out the extras. So remove rental car coverage, remove roadside assistance, maybe reduce the coverage levels a little bit. I mean, it'll at least give you a little bit of forgiveness on that, just to help your monthly costs.
Right, just to trim it out for in 6 months or something, you know.
Yeah, and just to remember, and also things where you can switch. Maybe it was business use, like maybe you were in an industry where you were driving around all day, and so your auto insurance rate is partially based on the fact that you're using your vehicle a lot. Well, even reducing it to pleasure use can at least give you a little bit of a break. Just realizing that any changes you make, it's going to be your responsibility to change back, because if you make those changes and then 6 months from now something happens, the insurance company most likely isn't going to proactively reach out. I had someone do that earlier this week and already set a reminder 6 months out to follow back up with them to make sure, hey, do you still want these things off of your insurance? Because I want to make sure they're still covered once we're at the other end of this.
Awesome. Well, that's a great service that you're providing to people there. So the other area that we're seeing a huge dramatic change in tone and conversation is in just the general financial markets. I think a lot of us who have 401ks and IRAs and are doing some retirement planning, or we're doing our best to save for the future. If you've looked at those accounts in the last few weeks, you've probably had some sad feelings because the market has gone down quite a bit. I'm super happy to have Kevin here from Lake Oswego Wealth Strategies. He's a longtime financial advisor, has a ton of experience. And Kevin, what are you seeing out there as far as what can people do? What do people have access to now that they didn't a month ago to help them bridge the gap if they're unemployed? And also for the people who are not unemployed and they're just sheltering in place, what are some opportunities or advantages with a market like this?
Yeah, thank you, James, for the introduction. And yeah, I do have some experience. I got into the business in 2008. Actually, I'm celebrating my 12th anniversary this month in the business.
Okay.
And
happy anniversary!
Thank you. It was an interesting time to get in the market, and has actually given me a bit of perspective. Getting into the business in 08, 09 when the markets were in free fall from the get-go, and then seeing what recovery looked like, seeing what it did to people that I was meeting with, and knowing the cash crunch that it put on a lot of folks. This is worse. I mean, from what I'm experiencing when I'm talking to people, I'm fortunate that most of my clients have prepared well for things like this. Hopefully people aren't too sad. As you mentioned, James, I mean, market fluctuations are inherent. I mean, it's going to happen if you're not expecting that your market, your values of your equity portfolio are going to go up and down. You're living in a strange bubble that doesn't include historical analysis. And so we know that this is coming. I've been kind of screaming to my clients for the last 2 years that there's a correction coming at some point. And so, it's just best to be prepared and expect these things to happen. Obviously, there's other reasons that are, to be sad right now with everything going on and people's income getting hit the way it is. But for us that, can work remotely and, continue earning an income, there is still a lot of opportunity out there. And I think that, trying to time the market is something that is, I warn clients about. It's very easy to try and do in a situation like this, wait for the bottom and reallocate or do some additional investing. But, we don't know where the bottom is, and it's volatility. I mean, it's going to be an interesting year ahead. James, comment?
What about, what would you say to someone who's like, well, I am unemployed, but I have this 401k, which I guess is now you'd want to maybe do a rollover and then you can access that money in a new way right now. Is that potential? But also that money's kind of down. So there's a problem with maybe selling those stocks when they're down. I mean,
James is referring to there have been some interesting changes that the recent CARES and Families First Act that the Congress has pushed through has provided some loosened guidelines as far as access to IRA cash. Normally, an investor cannot tap into their IRA money until they're age 59 and a half without incurring a 10% penalty and obviously owing taxes on that cash. And so during this time, during 2020, if you've been financially impacted by the COVID-19 in some way, whether that's, because you have been furloughed at work or your hours have been reduced or you're just not able to.
Or you've been sick or a family member's been sick.
Yeah, really anything that, if you've been negatively impacted over the last couple months, they will probably be able to find a reason to give you this break. And so if you need to tap into IRA cash, they're lifting that 10% penalty. If you need 20 grand, for instance, you can take 20 grand from your IRA and get $20,000 in cash. They're not even going to withhold those taxes immediately because they're also giving you a 3-year time frame in order to recontribute or re-put those dollars back in your account. And so it's a very, very nice and awesome way for people to float this. But James brought up another good point is, if every dollar is invested in a vehicle that is worth 20% less than it was a month ago or 2 months ago, is it a financially prudent place to raise some cash. If we have something that was selling for $1 2 months ago and now it's selling for 70, 75 cents, maybe it's not a good time to sell. And so, those things are going to be situational with your account, but any well-diversified portfolio is going to have positions that are stable in this type of environment. You should have a couple of positions that are in the green that you can liquidate if you need to and not have to feel like you're selling at the bottom. And so the problem that a lot of people run into in this kind of investing market is if you're not working with a financial advisor, you might look at your 401k statement or your 403b or whatever it is and see one fund, and that one fund is a target date fund, and it's designed to just contribute to, never have to change anything, and then when you're 65, it should be allocated properly the entire way along, and but
not designed to be accessed, like disrupted in the middle.
Yeah, and at some point it's got to be broken out. I mean, we use a bucket strategy for our clients. You have a growth bucket because we need to get from here to here, but we also need a safe bucket that is going to be a lot more stable value, boring type of an account to be accessed during times like these. And so when you have everything broken out in your portfolio, so you can see that, oh, well, my stuff that was up, 30% last year is now down 30%. Well, my stuff that only gained me 2% last year is still on track to get me 2% this year. And so I can sell that piece. And so these target date funds bring some issues when you're trying to create income and generate income out of them today. But there are ways to access cash. And if you're currently contributing, the loan limits for accessing your 401k have been modified as well. There were limitations. Usually you can only get to 50,000, a max of 50,000 or 50% of the value in your 401k. The new acts passed through Congress have raised those limits, so you can get up to 100,000 or up to 100% of your account balance, which is, it's a little scary to think about someone accessing and tapping into 100% of.
It's 100% financing.
Yeah, it's a scary proposition, especially if the markets do well, over the next couple months, and people are selling at a pretty high point. And I think it's going to have some potential trouble for these 401ks down the road. But
let me ask you this: this is something I've always wondered about 401k loans, because I can imagine families where like one person lost their job and the other person still has a job that is not impacted, and they have a 401k, but they've had an income hit. They may want to get into that 401k fund temporarily with a 401k loan. So let's say they have a $100,000 401k account, and you're saying they could take a $100,000 loan from that account right now. But let's say they're prudent and they only take $60,000.
Yep.
No stocks are sold to create that loan. Am I right about that? So that's a way to access money without actually liquidating and locking in a loss.
Yeah, and I was having a conversation with the client just yesterday that is an option, because they were looking at tapping into an IRA for some of their cash. We are not managing that, and it was in a target date fund. And so it's not a good time necessarily to liquidate that. However, the 401k of the husband had plenty of cash in it. And if we were going to call and tap in to see what that loan interest rate is, but it's going to be around 4 or 5, 6% max, usually about 5% right now, to borrow against that. And if you're taking 10 grand out and you pay it back within a year, that's $250 at a 5% interest rate. Or no.
Was it $500 over that period of time? If it's at $10,000 at 5%, $500, right?
Yeah, you're going to be a lot happier in the situation than paying that interest over the next year versus cashing out a position that might be costing you 20% in the long run. And so just thinking through these situations, if you need access to cash, they've made that cash available through your retirement plans, but whether or not it's still a good situation and which bucket to pull from is still going to be a conversation that you should have with your advisor. And
that's
so
the key. That's
yeah.
the key area that you need to deal with.
Yeah, and the there's been a lot of other conversations I'm having with clients where they do have some cash that they want to get a little bit more aggressive on, and the same piece as is true. I think over the next 2, 3, 4 months, 5 months, the markets are going to be very volatile. We're down 20% right now. We were down 30% a couple weeks ago. I think we'll be down 30% again in the future. But my clients, if they're wanting to invest, we are doing, we're going to systematically do it. Every Tuesday, we're just going to drop into the market 10 grand or whatever that number is. And over the next few months, you are going to get a lot of good buying opportunities. But if you're trying to time it, the problem is that if you wait too long, you're going to miss it. And You're going to be way behind the ball from an entry point than if you just slowly start getting invested. And so
yeah, dollar cost averaging. If anyone's listening to this, if they've never heard of the idea of dollar cost averaging, Google it. It's like one of the key strategies to amplify your returns, and it takes out a ton of risk as an investor. It's when you take if you have $10,000 to invest, instead of like buying the market on one day, you buy $1,000 a week for 10 weeks. And that spreads you out over some ups and downs. And you'll be able to when you project those dollars forward, you are more likely to have your portfolio weighted towards discounted purchases. And if the further out you can, and that's why 401ks are so powerful, is because it automatically dollar cost averages a certain amount. Every paycheck, $300 goes into that bucket. If it's up, your $300 buys fewer shares. And if it's down, your $300 buys more shares. So,
yeah. And, the advice that I have for a lot of my clients right now that are calling, it's not to turn the dial down as far as being aggressive. Most people should be thinking about turning their aggressive level up in their portfolios. When the market is down, if you're a 50-50 portfolio where you have 50% in equities and 50% in bond or fixed income positions, taking that 50% that's in bonds while we're at a discount on this bucket and dumping it over there, you're going to, when we do recover, if you are optimistic about the economy, you're going to see a lot of nice growth opportunity from that. And so there's a lot of doom and gloom when you look at your statements, and you might get a little sad, but it's just if you
the buying opportunity.
Yeah, if you take the right perspective, just get aggressive and know that our world and our economy is not fragile enough to get rattled for eternity from what we're going through right now.
Exactly. There is
past the next 2 or 3 years and see that the markets are going to be at least, returning to where they were at a couple months ago, and we're confident in that, then you should make your decisions financially according to that confidence.
Right.
Too many people get stuck in a bubble and scared, and you just have to have that long-term vision.
That's why having a financial advisor is so valuable, because it's easy to get scared and to lose sight of the track of time, and it's, we're as the human brain is not designed to think exponentially. That's one of the cool things that I think we're learning from this pandemic experience, is the whole flattening the curve concept. Everyone staying home is an exponential concept. Like, we are, the way this virus spreads is exponential. And so stepping out of our social interactions, chops that trajectory down and down. So we're all having a crash course in exponential thought right now.
Yeah. The panic that sets in and the emotions that are, surrounding investments. It's so funny if you look at historical ebbs and flows of money into the stock market. When the market is near its peak of the market cycle, so the last 2 years, there's been more money invested into the equity market than in the, probably 3, 4 year, 5 years combined prior to that. It's because everybody's like, oh, the market's doing great, and everybody's hopping on board. And then when the market, just starts tanking at this point, everybody starts bailing off, and our emotions cause us to do the exact opposite of what we're supposed to do. Instead of buying low and selling high, our emotions cause us to hop in when everybody's doing good and
right.
It's great when the markets are high. And then when we get down to a point like this, everybody gets scared and panicked, and they hit the eject button. And our emotions want us to do the opposite of what we actually should be doing.
That's right. That's because we are naturally wired to be immediate thinkers. Think about what's our situation right this minute. And you're right. The natural thing to do is to react, but you should take a deep breath, call your advisor. I read once somewhere that a good financial advisor makes all of the value for the client, not by like stock picking or, oh, we got a good idea, we're going to put you into this company that we discovered. It's really about talking you out of making a mistake once or twice over the course of 20 years, where it's like, I really need to sell, but you can calm that person's emotions down so where they decide not to sell at that time. Or if they're really high and they're like, I really want to push all this money in, maybe you're like, let's dollar cost average, or let's split this up a little bit, like that. It's a little bit more of a defensive concept, but just getting that perspective is so key. So I encourage anyone listening to this, if you don't, and I always ask people when I'm sitting with them around talking about mortgages and real estate, do you have a financial advisor? And I'm shocked at how many people, I'm not surprised that people say no. A lot of people don't have a financial advisor, but what surprises me is how many people think they have a financial advisor and they actually don't. They're like, oh yeah, there's this guy at the credit union that I talk to, or like, oh yeah, this person at my company 401k comes and sits down with us like once every other year, and that's my financial advisor. I'm like, what's his name? They're like, I don't know. I'm like, that's not what we're talking about here.
Great relationship.
It's not what we're talking about here. So anyway, get wise, get an advisor in your life. And if you're in Portland area, you should reach out to me or Kevin. And if you reach out to me, I'll put you in touch with Kevin, or call Kevin. He's a great resource for that as well.
Yeah, thank you for the commercial, James. And
Yeah,
I'll toss something on there because a lot of clients, don't think that they have a lot of assets. They might have all of their money in their 401k at work, and they don't think that they can be of value to an advisor. And just try and get rid of that thinking, because I think that even if that's where you're going to do your investing in the future, talking to a financial planner. I think that look back to the last 6 months, and the best moves I've made for my clients have been with their 401k, their existing 401k. And, I don't manage that money for them, but I do tell them, get out of what you're in right now and go to a stable value account with everything that has just, crushed it over the last decade. Every new dollar that you're going to put in, we're going to make very aggressive, but know that we need to cash in some of these winnings that you've had over the last 11 years. And so going to cash, if you're in the next, if you're going to retire in the next few years, or going to something more stable value, and continuing with your new money going in, dollar cost average, sure, keep that aggressive, but protect all this money that you've made over the last few years. And I can think about 5 or 6 different clients that, have reached out just to thank me, and like they feel so much more confident that we made some of those changes. And so just having somebody even look at what you're doing can add some long-term value.
Awesome. I love it. Well, we're getting close to the end of the hour here, and I'm sure that the podcast universe is running out of steam. So Aaron, any final thoughts before we wrap up here?
Yeah, I just wanted to say, kind of in line with what Kevin's talking about with the far out thinking and the panic, of somebody with whether it's their money they're investing in the market. My clients do the same thing, or I hear home buyers and sellers doing the same thing of, oh my gosh, what do we do? Should we be buying and selling immediately right now? And my advice is that don't day trade a house, especially a primary home, And if you're going to be purchasing a home right now, you need to think, are you comfortable with the payment? Or do you feel good about that purchase? When it comes time to sell that home, you're going to be selling and buying in the same market, whether it's a little up or a little down. That's not going to change anything. So
right, that's great. That's great perspective. I have a client, that reminds me, I have a client who's refinancing right now, and we needed an appraisal, and there was like this one kind of area of underwriting that popped up where we were confused about, oh my gosh, like, can we count this income or not? So I hit pause on the appraisal. So because I didn't want to, cough up $700 for an appraisal for a loan that we might not be able to do. And she called me back. We were discussing that, and she's like, well, I was really hoping the appraiser would get there because, and we're talking about delaying the appraisal like a week, right? And she's like, I don't want to do appraise next week because like the value might plummet. And I'm like, it doesn't work that way. Like we're not seeing, that level of volatility in real estate. And this will be a slow process. It'll take, by the time you realize that like maybe my home has gone down in value, by the time you realize it, it means it's been happening for 6 months, right? And by the time you realize like, oh, I think actually we're getting out of this, and that now like the market's coming back, all this stuff happens slowly, I guess is my point. Yeah. There's not going to be a real estate crash, but there will be a change in the dynamic
of it, for sure.
Yeah, in the short term.
Yeah. I mean, my answer to the question of if we're in a bubble is, I think we'll see some softening towards the end of this year, probably, and then it just depends on how long this plays out. How extended that softening might be, but it's nothing to be fearful about.
Yeah, agreed. Cool. Well, great talk. Thank you so much, everybody, for your expertise and insights. And we will do this again. Let's do this again in the summertime and see how right we were.
Yeah,
or wrong.
Look back and see it. And thank you for having me on. And I think just a note to everyone is we're all in this together, and to take a deep breath, because panic mode doesn't help anybody think clearly. Just take a deep breath and move forward. There's lots
of interesting positives that are coming out of this. We're all learning how to work from home. That's been kind of interesting. I've never really done it much, but I kind of dig it.
Yeah, and getting to know all my neighbors.
Yeah, exactly.
Exactly.
We were talking about that. We've seen our neighbors more in the last couple of weeks than we had in the couple of years prior. So interesting.
Yeah, I think a lot of good things are going to come out of this. All the sort of the finance stuff aside,
right?
Just for society in general.
Yeah, sure. Everybody's slowing down a little bit.
Yeah, for sure. All right. Well, everyone, stay safe. Wash your hands, and we'll see you next time. Thanks for.
Thank you, James. See you guys.
Bye, guys.